Hello, everybody. This is Israel from Israel Keys Wealth Academy. And well, you guys already knew that because you are in Israel Keys Wealth Academy. Um, so tonight's webinar is going to be pre-recorded, not live, for reasons that we've already explained on the WhatsApp group. And it's the second part. Well, it's technically the first part, but I recorded the second part yesterday. So on Saturday, I recorded a webinar, which you'll get at the same time with this, in which I started to go into a couple of things. Now, I'm aware about the fact that we've got both new and experienced traders starting the mentorship and the course at the same time. And what we're doing this year is we're testing out three things: the uh, the market breakers course, which is the step-by-step uh, delivery of the basics to the most advanced concepts of trading. And so we're literally starting from the ground up and building up till by the time you're done at the end of the year. For those of you who are brand new traders, you will know 90% of everything that we here at Israel Keys know about the market. I said 90% because we can't teach you everything in 1 year. Some things come with skill, with time, and with experience, and it'd be useless to try and show you. But 90% of what you need to be a market breaking trader, to break the code of the markets, you will have by the end of this year. But in addition, especially for the not so new traders, we've got the VIP membership or VIP mentorship and the Mastermind Inner Circle. Now, the VIP mentorship is for traders who want, in essence, you're not brand new. Perhaps you've gone through the market breakers course already or another course in the past. Although if you haven't done the market breakers, please do it. Trust me. I don't care what course you've been to. I've been trading now 12 years. Topper has been trading almost the same time. We've got a couple of other people in our stable of instructors. And between us, at least 50, almost 50 years of experience. There is no one out there, and I'm not saying this arrogantly, there is no one out there who will teach you everything we will teach you. Some maybe 80, 90%, but there's things that are that we've honed over the years and we've taken from different sources. We've learned, we've paid, boy, again, almost 50 grand between us, at least 50 grand in both losses and tuition fees. And so, and we are strategizing to deliver this to you piece upon piece. But even if you've gone through the market breakers course, if you're an experienced trader who wants to be mentored, and these are some of the things that we're doing on these webinars. And so, first of all, the access to us, the ability to, because half of mentorship is emotional and relational. It's not necessarily to do with the actual thing you're being mentored in. It's to have someone on your side who's walking with you, talking you through, and keeping you with your head up and your chest out and carrying through the uneven periods. But also you can send in your trade results. We can sit down with you and say, okay, why are you losing? Why did you lose this trade? Show me what you're seeing. And you get to pick the brain. But rather than doing a one-on-one, we do it as a group. And this is what a lot of the webinars are about, for you guys to come on and ask questions and interact that way. We're also going to be showing you tricks on how we apply the concepts we teach in the Market Breakers course. And so, but then there's the Mastermind Inner Circle, which is for really advanced traders who want a tool set to be successful. So you want analysis. We haven't started doing that kind of analysis yet to bring the newcomers up to speed. We want specific analysis on pairs and charts and markets, long-term, short-term, trade ideas and signals, in addition to other things. And so over the course of this next year, we're going to be trying out all these three on you at the same time. And the street value is at least £400 a month. And we probably will be doing 450 pounds a month when we put this out there for all three together. You're getting this for, I don't even want to mention it because it sickens me sometimes when I think of how much we're charging you guys for this. But the flip side is we get to test it out on you and get your feedback in making it better. So I think it's a good deal both ways. But on the weekends, we're going to be dealing with some concepts that we will teach in the Market Breakers course. But some of the people in this trial period are personal students I've had, or people I've mentored over the last year or two. And so you know some of these principles, and I wanted to begin to put them in a package which those of you who are more experienced can really start to use immediately while the newcomers are catching up. And for the newcomers, just watch them and pay attention to them. It's like learning a new language. It may not make perfect sense right away, But the privilege you have is, as you've been exposed to these concepts in the webinars, when you start to encounter the building blocks in your teaching in the Market Breakers course, you go, aha, that's what it's about. And so last week I showed you a trick that I don't think I've showed many of you, unless you've done a private one-on-one lesson with me. You haven't seen that, and I'm really giving away some of my best stuff off the bat to show you that we're committed to this process with you. And I showed you how the markets move from contraction to manipulation to expansion, retracement, and then target. CMERT. Contraction. Those are the little orange boxes I showed you. Let's see if I can find one to show you again. The orange boxes, you see it in this webinar, in the first webinar anyway, about how those, whenever you see price begin to contract, that is really the beginning of the period of trading activity. Now, I want to show you something else. And today we're going to use a different pair other than EU, because as many of you have noticed, I seem to be addicted to EU because it's a primary pair I trade. And this is a mentorship wisdom here. In every of this weekend seminar, we will drop some mentorship wisdom, meaning some tricks of the trade, in addition to some technical teaching and maybe sometimes some analysis. If you're a new trader, please stick to maximum 2, at worst 3 pairs to track. Why? Because you want to get a feel for the market. The damage of the indicator-based retail trendline nonsense style of trading is it doesn't encourage you to understand the story of the markets. And so you just jump in, you throw a few indicators on, you get a signal which is half the time wrong, or more than half the time, based on the fact that you keep losing. And then you jump in the trade, get emotional about it, and lose more and more and more, and then come out, cry, and then it goes your way eventually after it stopped you out 4 or 5 times. Because you didn't understand the story the market was telling. When you focus your trading on 2 pairs, and if you really, 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 really get bored, 3, it allows you follow the story over weeks, days, and months. And so whenever you are coming into the market, you have the context of a wider period of time to understand. And as many of you know, EU, the fiber, is my favorite pair. Why? It's the most liquid, and it's the most traded. It's by far the most traded pair. And it involves the US dollar, which makes it a major, but it also involves a currency, the euro, that is relatively stable because it's the aggregate of several countries' economies. And it's also a country whose opening and closing hours fit with my time zone because I live in London. If I lived in the States, I probably would trade the US CAD. I don't know, in Australia, the AU. And I trade the others from time to time. But I only look for another pair if I don't like what the EU is doing. There's certain weeks and months in the year where I stay away from the EU because it's going through some stuff. But if I find a trade in the EU, I will take it before I take a similar trade in all the other pairs. And you all know that I teach you that if you're trading majors like you should be, your primary source of filtering should be this here called the dollar index. Why? Because it is a filter. It helps you see what the dollar in its own is doing. And so if you are in a pair with the dollar as part of it, it gives you a bias. And these lines I'm going to show you here are actually part of what our training is going to be on tonight. So let's start with the dollar index. Now, we don't trade it. It's just a way of understanding what the dollar is doing. And so for the dollar's going up, we expect all the dollar pairs to go up if they're directly correlated, like UCHF or UCAD. And if they're going down, of they're inversely correlated and they go down. So it helps you pick a good pair to trade because you want to find a pair that's in sync with the dollar index, and then it helps you spot some stuff. I'll also show you down the line in some of our webinars how you can use the dollar index to rat out manipulations in the other pairs. For instance, there's 7 majors, or 6, but the Kiwi dollar, the New Zealand dollar against the US dollar is an unofficial 7th major. And sometimes you find 6 of them going one way and the other one going the opposite way. Sometimes it's a clue that something's shifting in the dollar. And so when you see one of them step out of correlation, and it's not because it was already inversely correlated on the long term, they were all tracking and then something happened. Each of them made a higher high when the dollar made a lower low or higher high, but one of them was held back or pushed forward. It's a sign that something's happening, but we'll get there later. So, okay, let me show you the US that. So this is the dollar pair. Sorry, this is the dollar index. Let me, I've just opened a demo account with a different broker than my normal broker because I want to take advantage of some of the functionality on that platform with the Mac, but I wouldn't trade live with them. I just use them to be able to get my software working on my Mac. So let us find, where is the dollar index? Okay. Could it be that they don't offer the dollar index, which would be another reason why I wouldn't trade them? Okay, let's see. New chart. This is show you how to find stuff in MetaTrader. So new, press that button there, and then you can pick. So I'm looking for an index. So these are all stock market indexes. Charts. Oh, there we go. Yeah, that's a dollar index. Yeah, so you can't trade it. Well, you can if you want, but you'd be very silly to do so, in my opinion. It's not designed to be traded as much as it is designed to be used as a tool of analysis. So that's the dollar index. But more on that later. So let us go. Let's go back to the Swissy. So that's the Swiss dollar. Now, these lines that you can see here, let me tell you what they are. Like I said in the other webinar from yesterday, I've invested in a software with a company that pretty much just helps me plot these lines automatically. That's all it does. All it does is plot these levels for me automatically, and it's costing multiples of what you guys pay a month for this whole market breakers, VIP mentor, and everything. Shows you how valuable this is. And if like you're like me and you used to trade for fun and you were trading thousands of dollars worth of profits or losses, then a few hundreds or a couple of £100 a month just to make sure your levels are correct will be a wise investment. I might stop it now that I'm not trading the fund anymore. I'm not trading my own money, but I want to see. But anyway, in my cadence scheme, red is weekly. So when you see a line on my chart, I've told you this, when you see a horizontal line on my chart, and the only two lines you see are vertical and horizontal lines, meaning price point, price levels, and points in time. You won't see trend lines with me. Unless I'm trying to show you how the market makers are manipulating trend lines with retail traders to take your money. And I have a color scheme that helps me understand what level I am bringing a line from. And that's important because when I'm on a lower time frame, for instance, like a 15-minute chart, so this is a 15-minute chart, for instance, when I get to a level, I want to know what time frame it came from because it gives me an idea of what to actually do with it. And these are arrows that I started deleting. I didn't finish. And so my cadence is I use red for the weekly, as you can see here. Now, I don't draw monthly levels because, first of all, I'm usually trading intraday, intra-week. And I said this yesterday. When you watch this, you'll see that if you're trading anything less than intra-week, the weekly pretty much gives you what the monthly will give you. You use the monthly just to see stuff, but the levels you need will all be there on the weekly. Of course, if you're trading anything from swing and above, yeah, you definitely want your monthly levels. So red is my weekly level or color. So if you see a box or a line on my chart, it's red, it's the weekly. If it's green, or sometimes I use saddle brown instead of red for the weekly. If it's green, it's daily. Daily is always green for me, and 4 hour is always purple. And then sometimes I use blue to signify the 1 hour. And I rarely draw levels on the 15-minute chart because the levels I'm drawing are not are designed to show me what's happened in a higher time frame. So when price gets there on a lower time frame, I'm not caught by surprise. And many of you get burned. And I'll be honest, I still make that mistake sometimes where I'm so focus on what's happening on a 1 hour chart or 15-minute chart. Some of you also focus on what's happening on the 5-minute or 1-minute chart. Oh Lord, you are worthy. And you just forget the fact that market makers don't care about the 5, 15, even the 1 hour chart. The lowest chart a market maker looks at most times is a 4-hour chart. And so the levels that drive price via liquidity, as we'll see, are all marked on a 4-hour and above. I want to repeat, the levels that drive price are marked primarily on a monthly, a weekly, and a daily, and sometimes on a 4-hour, and that's it. And you need to understand where these levels are when you're coming out. The same principles work on the lower time frames, but you can see when you're trading the lower time frames, they're obvious to you. You can see them because they're near where your eyes are. It's easy to forget what's happening higher, and that's why you want to superimpose those levels. So as you can see, I've drawn out now. I did this in December. I haven't incorporated January's. As you can see, this chart actually hasn't updated since January, since the end of the year. So this is not going to incorporate the last month and a bit of trading. But let's go back to it because I just couldn't be bothered to draw the lines again, as I'm not trading the Swissy right now. So as you can see, I have marked out what I believe are significant highs and lows, or what were significant highs and lows in the month of the month of December. Of course, some of them went from way back. How far do I go back? This is some of the most advanced understanding you can get, and I'm giving it to you at the beginning. Remember, price is driven by a computer algorithm. Human beings aren't deciding what happens with price. They're trading it, but there is something called a price delivery algorithm or price algorithm that all the market makers use on their interbank exchange system. And a machine cannot make intelligent split-second decisions without data. And so if you are trading price against time, I'll keep saying this till you're blue in the face. The two most important variables to feed that algorithm are price and time. And like we taught in the Market Breakers course already, as technical traders, we believe that the most valuable determinant of future price action is previous price action. This is true because that's what the algorithm or the computer program believes. And it uses data from the past to decide or judge the future. I repeat, it uses data from the past to make decisions about the future. And if the two things we're trading price against time, it needs variables of price and time. And so it gets the price variables from previous price levels. And I've shown you this several times. Just on any chart, take a line at a place where price had a significant reaction. Let me show you this. I keep giving this example. I'll show you another one. Just pick a chart. Let's pick the 30-minute chart, which is not a chart I like to trade. Okay, price reacted significantly here. I'm not picking it I'm just picking it random. Let's just throw a line there. See what happened there? So price reacted here. Let's just show you this because so you haven't seen me do this. Look at that reaction, right? What happens in the future when price goes there? It bounces off that line. Let's go back in the past. What happens when price comes here? It spends a significant amount of time dancing around that line. In the past, okay, there's a gap there. 1 second. Let's keep going. Back in time. What happened last time price came to that line? Again, what happened? It coagulated there. Went up, went down, went up, touched it to the pip, and then went. What happened the last time price got there? Can you see? And this is just random, just because what's happening is, and I'm going to show you how this works in human. The first principle is the algorithm understands liquidity. So it drives price from liquidity points to liquidity points because it knows what happens at liquidity. And I'm going to show you that in a second. But just go back in time. If you want to zoom out just to see it even more, just look at every time price gets to that line, something significant happens. This works on every single time frame. Every single time frame. And you can go back in history as long as you want. And it will usually happen bi-directionally. Sometimes it'll be used to short price. Sometimes it'll be used to make price go long. Sometimes it will consolidate. That's just the way it works. And so the computer understands that. The second thing it needs is time. And as I showed you on this, the JAPI, for instance, if you look at this on a daily chart, for instance, you see, look at that same line. Look at what happens every time price. Let me just do it this way. What happens every time price comes to that line, dating back to 2014. So 5 years, that line is still significant. See, isn't that just beautiful? Let's go further back and see what happened the last time it came there. Look at this again. So now we've gone back 18, 19, 20 years, and you see the same principle holds. Now, the computer, the algorithm, as we call it, is not going to be storing information from 18 years ago because it would literally explode at some point. But it knows this. Every so often, price will revisit those levels over and over again. And so it is designed, listen in here very carefully, it's designed to look back in multiples of trading months. By trading month, I mean 30 trading days. Now, there are less than 30 trading days in a month because from Friday night to Sunday night, the market closes. So a trading month is 20 days, is my point. A trading month is 20 days. And so the computer or the algorithm is designed to look back in multitudes of trading months, which is why the monthly charts are very important. And if it finds significant levels near where price currently is from the last trading month, it will work with those. If it needs to go back another 20 and another 20, it'll keep going back in 20s till it finds a significant period of time, significant level of liquidity in that time period. Now, what do I mean by liquidity? Please go watch the Forex basic videos that I did in the free mentorship last year. They're free. They're on YouTube. The whole world has them. If you're paying, you should have them. I'm not going to repeat them because time is precious to us on this mentorship. But what happens is you are trading against people with deep pockets. What I mean by that is when you put a trade on your computer and press trade, it automatically just goes bing, right? Yeah, because you're trading $1,000 and your trades can't move the market. And there's always somebody ready to buy $1,000 in whatever currency. If you were George Soros or you were Lehman Brothers, let's do a bank that's still healthy. If you were HSBC and you wanted to trade $1 billion from dollars to Swiss francs, first of all, it's going to be hard to find somebody willing to buy $1 billion from you to sell to get $1 billion, to get whatever it is in francs. Secondly, even if someone wanted to enough people to buy, if you put all that liquidity in the market at once, you would move the price because the market would jump because there's $1 billion being pumped into it, and you'd end up filling some of your trade. We call it filling an order in foreign exchange. You'd end up filling some of your trade at a much higher price than you wanted. It'd be like you saying you wanted to buy 1,000 Bentleys. By the time you got to the 5th or 6th dealer, the word will have gone around town that someone's buying 1,000 Bentleys, and all the prices will start to rise. So they have to do it gradually. So for instance, as price is coming down, market makers start to buy. They really want to buy down here on this swing here. So they want to buy down there, but they need to price in their orders gradually. And you see, every time they put in a major price, it jumps up a little bit. And so every time it's coming down, they're buying and buying and buying and buying until they get to the point where they filled all the orders they need to fill. and then that goes the other way. And so they need to take their trades at levels where there is one, willing, and two, unwilling liquidity. Willing means somebody wants to buy, someone wants to sell to them. If they're going to buy down here and on the way down there, someone needs to sell to them. Who could be selling to them? Somebody who wants to buy francs anyway. They want to pay for fees. They want to buy a product from Switzerland. They don't care about the price of the market per se. They just want to, that's one. Secondly is stupid. We call, and I'm not insulting us. I'm saying I call it stupid money or dumb money. Stupid money traders who don't understand what's going on. Let me give an example of what might happen. They'll draw a line here and they'll say, if price breaks that level, this is called what we call breakout trading. It means it's going down. So the moment it breaks that level, they put a sell order here because they believe this is a sign that price is going to keep coming down. But smart money traders like you're going to be soon, and the market makers who are always smart money, understand that this then becomes what we call a pocket of liquidity. So let me throw this away for now. So here, under this low is a pocket of liquidity for two reasons. One, breakout traders are telling themselves, if price goes beyond that line, I'm putting an order to go short. Newbies, you see this as we go along the course, but experienced traders, you understand this. So they put a sell stop order. And the moment price crosses that line, they're now trapped in a trade that for them to win, price has to keep going down. But a market maker will have put a significant, say $1 billion of buy orders there because it knows that dumb money traders are going to put sell orders there. And therefore they get unwise, let me use the word unwise, willing liquidity. Now, so in essence, somebody here just wants to sell because they want to use the money for business purpose. They're not trading the markets per se. They want to buy something in Switzerland or send money to Switzerland. So they don't care about this and the pip range. They're just going to sell here at this price because they woke up that day, they needed francs, and so they're selling dollars there. Secondly, traders who are looking to make a killing going south, not knowing that they're being set up to be eaten for lunch, will put their orders there. And because it's a sell stop order, meaning they want to sell the market, they believe once the market crosses there, that's what they're taught. It's a sign of weakness, and then the market maker buys. So the orders get paired. Let me put that in here because I need you guys to remember this. This will save your life. The orders are paired. In essence, the market maker, the bank, the hedge fund, whatever it is, and also you with your little money, because now you're trading like a market maker. So you also have your buy order there. And so when price comes there, because there's a bunch of people who have been manipulated into selling, the buy orders are filled and it goes long. So that's willing liquidity. So let's put that there on the chart. Willing liquidity. It may be stupid liquidity, but it's still willing because you have people who want to sell there. Now, you also have unwilling liquidity. And let me explain what unwilling liquidity is. This is what many of you have been. And I am about to deliver you from yourself. And this is what makes the world in trading go around. People who don't understand what they're doing. If everybody who traded understood what they were doing, the markets wouldn't be as fun for the people who do anymore. But there's always going to be somebody who's trying to make $1 million overnight, so you're safe. So this is the unwilling liquidity. These are the people who were a little bit sharp. If you, let's say you bought here. Let's put that back up. Let's go back to our, right, where were we? It was the September. Okay, so let's find it. So there we go. So I'm going to put in my order indicator. Oh, actually I can't because this is not a pair that I'm trading. It's not. Okay, it's fine. So let's assume we can make do with this. Let's assume that you decided you're going to buy the market here. So price came down. Look at this, and it rejected nicely off that level. That would have been a reasonable place to put a trade at that level, the purple level there. So you put a trade there, and you're looking. Let's say you're looking for, because this is a weekly chart actually. So on the weekly chart, I don't know. Let's say you're looking for 10,000 pips. You think that's crazy, but if you're trading the weekly charts, you will be looking for 10,000 pips. You know, that's not a bad range to work with over the course of 6 months for position trader. So it's gone to 6,000 and it's taken out this high here. So you believe it's going to keep rising, and you would not have been unwise to believe that. It could very well have done so. And then it starts to come down. Now, if you entered here, what are all retail traders taught to do? To put your stop loss under a low and above a high, a few pips above. So you put your stop loss there. The thing is, the market maker knows your stop loss is here. First of all, they know the traders always put their losses above and below highs and lows, and that's the only place we can really put them. Many of these market breakers trade without a stop loss because they can absorb millions and billions of losses, believing the market will reverse. That's what caused the financial crisis, because there were traders who were down billions of pounds or dollars, believing things would turn, and at some point they ran out of liquidity, of capital, and then the market went belly up. Secondly, they have information on their systems that actually tell them where the orders are. They may not know whose orders they are, but they can see information on their systems that tell them, say, there's what, 5 billion worth of sell orders there. And so they're going to drive price there because it helps them pair their orders. Now, if you bought here at this top line here, if you were in a buy trade, to come out of a buy trade, your stop loss is going to have to be a sell trade. Meaning the way you close a trade where you bought is to sell. The way you close a trade where you sold is to buy. And so your stop loss, and many of you don't think about this when you're putting trades in, your stop loss, your take profit. If you're a buy trade, both your stop loss and your take profit will be sales. Both your stop loss and your take profit will be sales if you're in a buy trade. And so this guy who was waiting to get 10,000 pips has only got in 6, it comes down. He tells himself, don't worry, it's going to go back up, and then it starts to drop. By the time it comes here and nicks his stop loss, he is now unwilling liquidity. He didn't want to be liquidated, because liquidity simply means when an order is liquidated, when the position is turned to cash. It's either turned to cash for a profit or loss. And so at this point, his buy order is liquidated. He then has to sell unwillingly because his stop loss says you can't lose any more money than you've already lost. And the market maker is there to pick it up and take their buy. And I don't know what happened here. Let me see. But many times it will then continue in the original direction. And the guy goes, oh, dang it. But it's already late by then. Now, another example of willing liquidity I forgot to mention is for the guy who sold here, he's been told. So for the guy who sold here, sorry, this point here, he's been also told that you get in and you get out of a trade you're winning again, where at an old high or low, and he's right. And so since he sold here, by the time he comes down here, he's made roughly 6,000 pips. Well, in this case, okay, so he's made 9,000 pips, and he's really happy. And so if he was in a sell trade, right? If he's in a sell trade, his take profit's going to be a buy. Think about that. If he's in a sell trade, his take profit to come out the trade, he's going to have to buy, quote unquote, to close the sell. If this sounds weird, go to the first 2 sections of the Market Breakers course. We explain how CFDs work to understand why you can sell first without buying. And so when he gets here, he wants to close the trade. He needs to buy. There's already orders that are here that are paired. So in essence, he's acting like a market maker, even though he's not a market maker. And the reason why it's good to get out here is because there are that many because that many sell orders there, it's difficult for price to push through that level, because to keep pushing through that level, there has to be selling pressure. But all the sell trades are being paired with buy orders. The only way price crosses that level is if there's more volume, more money wanting to sell than is in this area wanting to buy, either willingly or unwillingly. And we call this a liquidity pool. This right here is what we call a liquidity pool. And we will see in the Market Breakers course, there are several things we call liquidity profiles. A liquidity profile is a chart, pattern, or element that tells you there is likely to be high liquidity in a certain area. And therefore, when price gets to that area, it is likely to stop, be held up for a while, or reverse altogether, because the pressure taking it one way is going to meet liquidity. So if you're selling, the selling pressure, meaning there's plenty of sell orders. If you run sell orders through a buy liquidity pool, remember I said everybody here either just wants to buy willingly, or their stop loss is forcing them to buy because they entered, to sell, because they entered the trade. So there's loads of sell orders there because people wanted to buy. Those sell orders are going to pair up with the buy orders, and the price is going to shift. Also, market makers are going to put loads, like I said, if they want to buy, they're going to put loads of buy orders there, knowing that the sell orders coming down are going to pair. So it works both ways. So this is a liquidity pool. This is the simplest one, highs and lows. There are other ones which will show you, e.g. order blocks or supply and demand zones, but this is the simplest one, old highs and lows. Because above an old high and below an old low, there will be a pool of liquidity. The question is how much liquidity? Well, that's decided by a few things. First of all, the higher the level of the time frame, far more liquidity will be resting there. So weekly highs and lows are going to have billions of dollars. Dailies may have millions. 4 hours may have hundreds of thousands, or whatever it is. Which is why I want to know what color or what level, based on the color, that high or low is coming from. If it's red, my weekly is in red because it's telling me price will respect it. It may still keep going past it, but it will respect it because there's going to be so much liquidity in that zone. The price is going to temporarily stop and or turn until more orders come in the opposite direction to counteract the direction of price. Daily is green because it's a money time frame. Purple is 4 hours purple because for me it's the royal time frame. And we go like that. So now that you understand the backdrop of liquidity, let me put the dividers back in. This is what, now bear in mind, keep this in mind with the other video you're going to get that talks about the expansion manipulations, the consolidation, manipulation, expansion, retracement, and target. Now, so as you can see, all the green, first of all, the red ones are coming from weekly highs or lows. Again, there are other liquidity profiles, but highs and lows are the simplest ones to understand. And when you understand how highs and lows work, you can start to understand the other ones. Because when you look at my chart, sometimes you see lines that don't come from highs or lows. They come from the other liquidity profiles. But this just helps you understand. So the red, like I said, is weekly. What I do is I start from the weekly, and I drop down to the daily. Some of the daily highs or lows will already, for instance, this is a daily high. but it was already captured because that daily high was also a weekly high simultaneously. So you drop down to the daily to find the ones you missed, or the ones that the weekly didn't show you. And then I would then drop down to the 4 hour again. I'm not done that here, but let me give you an example. I would usually come down to a 4 hour. There we go. And I would draw, again, the weekly highs or lows that I missed based on the 4 hour. So in essence, over the last at least 20, and in multiples of 20, if you don't come again to that. Now you want to see what's above and below in price. What are the liquidity profiles, in this case, highs or lows, that are above price and below price? And if you're trading, for instance, if you're an intraday trader, meaning you're only analyzing for the next few days, ask yourself, how far is price likely to travel in one day? So let's assume we were here. Let's assume price is here right now. So below us, that's 152 pips. Above us, that's 240 pips. If you're a day trader, you don't really need to go further back, because price isn't going to travel 5,000 pips in one day unless there's a market crash. Of course, if you're a weekly trader or swing trader or above, then you might want to go. So ask yourself, over the period of time I'm trading, how much is price likely to rise or fall over that period? And then try and find liquidity profiles. So if you're a swing trader, try and go back roughly 1,000 pips above and below. Now, let's look at what happens on a lower time frame. Let's drop down to 50. Let's do a 1 hour first. I'm going to take you back. Now, remember, the 4 hours are missing. In fact, let me throw a few 4 hours there because it makes it more. So let's see what. So these are. I'm looking for 4 hours. Those are going to be purple. There we go. Let's try and not make them crooked. Awesome. Let me zoom in to really see. So what are the 4 hour levels that weren't captured on any of the other charts? Let's see. And unlike most people teach you, I want you to cut through candles. I'm not asking you to draw the levels with clear space. Cut them through candles. So for instance, we're cutting through candles here, 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 here. Just go back to, like I said, so in this case, I'm going to go back. Let's assume I'm going to go back 60 days. 60 days is 2 months. So this here is February. And we're going back. 60 days will take us back to sometime in December. So we've actually gone far beyond 60, which is good. But you see the point. So let's throw a few other. For instance, look at how this one beautifully overlaps. So if you just run out that price from there, on the day you were trading here, you would have seen the price would have respected this to the pip. But anyway, I digress. I'm going to leave the rest of them because since I'm not, and this is why I wanted to pay $200 a month to have a software that does this for me, as you can see now. So if I like when I was trading in profits and losses for that micro fund of $5,000-$10,000 a week here or there, you see why $200 a month to draw these things for me was not too much to ask for. Anyway, so let's drop down to a lower time frame and see the magic as it occurs. So 4 hour. Let's go back in time. Look at what happens if, okay, so this, for instance, doesn't look, and again, we didn't draw them accurately, but that's just 4 pips. So price turned 4 pips from that line. And I could almost bet that if I refine that line on a 1 hour chart to where the original high or low was, it'd probably be to the pip. But look at what happens as we go back. See, let me just throw a few out for you to see. See how price is respecting those lines. It either, even if it's passing it, it stops for a long time. It pauses. These are the things. So this is what drives price on a lower level. It's not your stochastic or your RSI. See what's happening at these levels. I'm going to add that because that's so close. Anything within 5 pips is valid. And we can keep going back and we'll see. Now, in some cases, these are the highs or lows of days or weeks, right? See, isn't this just beautiful? And now you understand why. Because if price is going in one way and it runs into a pocket of liquidity, meaning if it's a buy order and it runs into several sell orders, they're going to pair. And in essence, if the pressure is buying, let's assume there's 10 billion in the buy direction. If it meets 9 million sell orders, there's only going to be 9 billion, there's only going to be 1 billion left. It will slow it down. Now, if 10 billion buying pressure runs into 20 billion selling pressure, it will take it back the other way. You get the point now. And that's why you need to have these levels on your charts. They're called liquidity levels. Look, see, isn't this just, I mean, why would you waste your money if you don't in advance know where these levels are? Look, see, on this week, I'm just gonna take this entire zone here to show you. This is where several levels converge. Can you see this? It's just stunning. Look. This is how you become a genius in the eyes of people on Twitter and Instagram. If you're that arrogant that you trade for that kind of stuff. Look, see. I don't know how else to say it. Please, right? This is what really drives the market. This and the stuff I showed you last week. So let's go back to an example of what I showed you last week now. Right. Let's take one of these. So remember I told you on any time frame, on a 15-minute time frame, this is for day traders. Let's give an example. Let me take that away now so I can use it for my example. We said consolidation, right? Okay. So at roughly midnight, the beginning of the day, what happens here? There's a price consolidation. Can you see that? And where does it consolidate? It consolidates at the level of a daily liquidity profile. See, green. So we said, let me type this in. Remember, this is the cadence I said we're looking for of what really drives the market. So we will have a consolidation, right? And then after the consolidation, we are now, sometimes there's no manipulation. Sometimes price just goes 20% of the time, but I'd rather be out of a move wishing I was in than in a move wishing I was out. One of my trading mantras. I'd rather be out of a trade, said, oh, I wish I took that trade, than be in a trade and think, oh, I wish I didn't take that trade. So always wait for the manipulation. If it doesn't come, wait for the next trade. So consolidation. And then we will have, after consolidation, come on. No, that's not what I'm looking for. No, that's not what I'm looking for. There we go. After consolidation, we expect a what? Say with me now, a manipulation. After the manipulation, we expect an expansion in the right direction, meaning price now begins to take off. After the expansion, we expect a retracement back to a lower, higher level in essence. And what's happening? Let me explain what retracements are. A significant retracement means they didn't get all the orders they wanted to fill. So they're coming back to that level where they found liquidity in the past to try and get more liquidity to go in their correct direction. So that's a retracement. I'm not sure what's going on over there. Okay, so retracement, and then it then goes to its original target. And so target, let's put that in there. Target. So let me show you how this works. Let's use a 15-minute chart. This works in any chart, any time frame. So there's our consolidation, and we expect one overnight. Every day we expect a consolidation overnight, right? Where does it happen? At the liquidity level. Anyway, I'll just move on because I don't want to sound like I don't want to overdo it. So that's your consolidation. And then remember what I told you? You want to take the range of consolidation. So that's the high of the consolidation over there. And this is the low, right? And what would you know? The daily liquidity level is roughly 50% of it. So that's the average price in that consolidation. Whenever you see the consolidation, remember from, well, you will see this if you haven't watched that video already, you'll see it. But I'm going to send that first. So you should be remembering by the time you see this one, that's the beginning of a move. If you spotted the right consolidation. So here comes the manipulation. Price goes in the other direction. That's the manipulation right there. And everybody wakes up that they're saying, Swissy is shorting. And everybody is putting their short orders. Price comes there, and I will almost bet you that that level there is another liquidity level from some time frame. Let me just throw a line on there, and let's see what we find. So that's where we're coming from. See, look. Can you see that? That line in the past has been significant. It's been a liquidity profile in the past. But anyway, look at this, actually, from 2 days ago. There we go. That's what I'm looking for. 2 days ago. See this, 2 days ago, that was a 15-minute swing low. There we go. So there's liquidity there. It tapped into it and then went. It also lines up with another liquidity profile, which I'll teach you soon, called an order block. This entire region here, you might see me put this on my chart sometimes. That in itself is an order block right there. But anyway, that's beyond the scope of this mentorship session. So that's your, let me put this in there so you can see. So this is your consolidation. Let's put a C. That's your consolidation at a liquidity level. This is your manipulation. The entire swing down here is the manipulation. And again, it comes to another liquidity level. And even if you just ignore this exact level here, it's what? How many pips? It's 4 pips from a weekly level. So just ignore this for example. Let's just assume you're expecting something to happen around here. We're going to show you why you always wait for confirmation. So that's that. Let me put this here so there's space between them. CMERT. There we go. So that's the manipulation right there. And then you get the expansion. Now, how do you know it's the expansion? It should break market structure. Some of you don't know what market structure is. I understand that. I'll teach it. But for now, just understand that in essence, since we're looking for a bullish move here, an upward move, price has now taken out the last high that was formed prior to the consolidation. So when price takes out that higher high there, we'll explain market structure in a lot more detail soon. Just stick with us over the next few weeks. That is a break of market structure. And so this is a confirmation that this is an expansion, not because it's broken market structure in the direction we expected. Now, what would have happened is, based on the higher time frame directional bias, using things like the daily engulfing and all that stuff, we would have come into this day expecting a long. We start with the consolidation. It starts to go down. That's confirming because we know we're going long, but we're waiting for price to find support beneath the open price. This confirms to us. So that is there. The expansion. No, I'm not looking for you. I'm looking for a copy of you. So that's the expansion there. It's expansion. Now they want to come back into that zone to pick up some more orders. So it doesn't just run away half the time or most of the time. It'll come back a little bit. And one of the things that this does for them is if you're not sure, if you just got in luckily, when you see it coming back down, you're going to be scared. And then you're going to close your trade again for a loss. And so they make money both ways. But that here is the retracement. That right there is the retracement. Let me fix my hours a little bit. That's the retracement. That's the R. And if you double click on anything in MetaTrader 4, double click on it and then hold control while you drag it away, it just makes a copy of it. So that's how I'm doing what I'm doing. That's the retracement, the R. And then it then goes to the target. What is the target? Whatever target you pick, it'll usually be another liquidity line. For instance, let me show you this. Even though with this thing come from a higher time frame, you can see that yesterday this formed. So that's a liquidity line from the same time frame. So you'll be keeping your eyes on that. But pick any target you want. So you start to counter back to existing liquidity lines from the past. So that would be first target. It's a liquidity line. Remember, green means it came from a daily. So we're going to call that target 1. We're going to call that T1. It's T1. But it doesn't stop there. It keeps going from T1. For the sake of just showing you, let's ignore this line because this would have been the perfect place to get up to. But let's just pretend that we didn't even keep that in mind. We just came in with what we came in from before this week began. From here to here. That's another liquidity line from the past, right? From a higher time frame, a 4-hour, because it's in purple. That there will be target 2. So it means that when I tell you I took some off my trade at one point and I took off another part of my trade at another point, this is why. So that's target 2. But we keep going. There's more above. And notice what happens every time it gets to this predetermined liquidity lines. This is going to be target 3. Target 3. See, it keeps going and it's always stopping to make up its mind at a liquid. It's like a bus stop, right? You get on the bus, it doesn't just drop you in the middle of the street or the motorway. You have to get off at the next bus stop. And so I call these bus stops. And then you can see this target 4. And if it kept going, there was a 5, and then it starts, there's a 6 here. You see? And that's how you do it. Using liquidity. On all time frames. Consolidation, expansion, manipulation, expansion, breaking market structure, retracement back into the same level, usually halfway point in this, anything from halfway point in the consolidation and below, and then it starts to hit targets until it reverses. Now, what this is doing on this time frame, on a bigger time frame, it's also doing as well. Let's look at the 4 hour. So let me show an example of a 4 hour. So let's see. So we have, look, see here, it's an example. We have a consolidation at a level. We have a manipulation, see there? And then an expansion, see there? So that's the expansion up the way up to here. And then it retraces back to that original level. And then target 1, it retraces a little bit, and then target 2, then it falls out of bed. And so as you're plotting what happens in a bigger time frame, you can then drop. So in essence, when we saw this here, it consolidated, it manipulated. We might not have known it was a manipulation, but took that out, see, at that level there. And then it broke structure up here. At this point, when it dips back in here and then starts to turn again, we now understand what's going on. We expect it to come back up here and then even higher. And so we can take this chunk here. So in essence, this period of time here, right? We expected price to go up because we've seen a consolidation, we've seen a manipulation, we've seen an expansion and a retracement. We were expecting now it to start to go to target. So remember, a 4 hour chart, the dividers are weeks each. So we would have come into this week saying we're expecting a bullish week, right? So this is the week of the 4th of November. We're expecting a bullish week. We would have come to the daily, 4th of November, that's it there. And the moment we saw the engulfing, let me dig into that. I'm sorry, the chat looks a bit messy, but it's the best I have to show you today. I didn't want to go through the process of the 4th of November, of dragging a brand new, actually, what am I doing, 2005, of dragging a brand new chart from scratch. So there we go. There's it there. That's the period there. So remember we said, based on what happened in the 4 hour, we came into this week here, expected it to go up. This, let me take the dividers off for now. So this is our engulfing. This candle here would have been the engulfing, a sign that we were looking bullish, right? And so on this day here, would have been, so we came into the week expecting it to go up based on the 4 hour consolidation, manipulation, expansion, retracement. We had the confirmation of the bullish engulfing, meaning our directional bias is confirmed. And so we would have expected the next day to be a bullish day. Let's drop back. That's the day of the 5th of November. Let's go back to 4 hour chart, the 5th of November. There it is. So we expected from then on, from this point on, we expected price to go up to where? To targets that were at least, in essence, if this was the consolidation manipulation, if this was the expansion, we expect price to at least get back to that level of expansion. Price should at least come back there, right? And exceed it, but at least come back there. So from this point here, from this level here, we have what? 92 pips to work with that week. And we know price is going long. We've already put in our liquidity profiles. You drop further down to a 15-minute chart. Let's go back to the 5th of November. Go back to 15-minute chart. If you're day trading, and then you start looking for consolidations, manipulations, expansions, retracements, and targets being hit on a 15-minute chart in the direction that the higher time frames have given you. So the weekly, the daily, and the 4 hour are telling you go long, right? And so it's the 5th of November. There should be a line marking it out. There we go. So that's it. So that's the line, 5th of November, right? So put the dividers in. In essence, this entire period, we know price is going up. everywhere in this yellow box before it formed, based on the fact that that's the level of the old expansion, and we've seen the daily engulfing in this day. So the engulfing happened in this day here, right? This, the 4th of November. So coming in, what do we see? We see a consolidation overnight, as we expect. We see a manipulation. We're not chasing this here. An expansion, a retracement, target 1, target 2, target 3. You get out here, you close for the day. The next day is a sideways day. You can't do anything about that. They happen. We call them Z days. If you got in here, price went up, went down, went up, went up. It didn't want to leave that portion there. Now, if you're wise, you're getting in here, you're probably going to put your stop loss at least somewhere around the previous day's high or low. So you might have not made any money this day, but you shouldn't have been stopped out. And then the next day, what happens? So this entire day is a consolidation. This entire day, in fact, let me put that back. This entire day is one big consolidation, right? All the way up into the next day. And then what happens? Price fakes you one way. You're not running because you know it's going up, right? You expect it to go up this week. You want to see a significant down move first as the manipulation. If it runs away, it runs away. You shake its hand, you come back next week. But you're waiting. Consolidation, right? Manipulation, expansion. The retracement comes to the next day, right? So you see why you want to follow price over time on 1 or 2 pairs. You don't just jump in and say, oh, no, you want to follow the story over the last few weeks or months and have been stalking the trades. So the next day's consolidation lines up with the retracement of the previous day. Back again. See, we drew all these lines in advance. Remember, we draw these lines in advance. That's why they're there on our charts. And then what happens? Actually, that's the wrong consolidation. This is the consolidation here. See, that's the consolidation there, right? It breaks out of it for a 15-minute, but it comes back in there. And then a fake out, but then this is the real manipulation. So that's a consolidation. That's the manipulation. Expansion, retracement, target. And then the next day, next week, something happens. There's another consolidation here. So at that level there, price reverses. And then in hindsight, we now realize, hold on a second, the final target being hit on the way up, that area became the consolidation. And now the scripts are flipped. Now this was a consolidation. What we thought was a target was actually a manipulation going that way. How do we know? Because price breaks down under the last consolidation. I'm just going to use the line that already exists because it does the same job. So price breaks down. I'm trying to close you. No, I'm trying to close you. There we go. Price breaks down under this last consolidation and it settles beneath it. And we go to the D1. We will see on that day, where are we? 4th of November. Sorry, we'll see on the 4th of November that there would have been a daily engulfing in the other direction. 4th of November, right? There we go. So we see there's a daily engulfing in the other direction. That tells us the bias has changed. It's now short. At that point, we say what happened. We drop down to a lower time frame to see what's going on. Let's go down to the 1 hour to help us with this one. Come down to a lower time frame, and then we start looking for the same pattern in the other direction. Now that so there we go. That then becomes a consolidation, manipulation. So that then becomes a consolidation, manipulation. See how it's respecting these levels, retracement, expansion. And then it reverses again at the next daily engulfing. And then we come back. By the time it engulfs, because this would have been the day that engulfed that candle there. So we come back and we say, okay, it was the last consolidation. There was the last consolidation before the engulfing, right? So that becomes a consolidation, a manipulation, an expansion, a retracement back into the same area, C. Target one, a deeper retracement. This happens sometimes because they want more orders, and then it starts to take off. And then it goes, and then it reverses again at some point. And you see again, when you see the daily engulfing, you go back, consolidation there, manipulation. This one just ran. It just ran. It didn't give you much of a retracement. It just ran away. You will see this happen. And like I said, you shake its hand. And once it starts to do it, it'll give you a chance to get back in, because somewhere along the line, you see another consolidation there, still in that direction. Manipulation, expansion, retracement over a few days, and then it starts to hit target. Now, I know it sounds very simple in hindsight, but it's not that easy in live time when it's happening. And that's what experience brings. But we need to show you what's actually going on. And on a larger scale, this is all that's happening. Price, let me get rid of all that stuff now. So let's get back to the clear chart that we had when we started. Before I started writing all these things. All that's happening, right, is price is respecting liquidity lines, liquidity zones, liquidity profiles. That's it. Trading is governed by liquidity. So highs, lows, there are other forms of liquidity, but this is the most important one. So it came up here. See, look at this. It left this line behind here. Next time it came back to the line, what happened? It turned, because there was a liquidity pool there. It tapped into the pool, and then it went away. And then it came back again. I remember now this line, let me put that now. When it came back again, remember that at that point, this would have also left a line, because at the point it became a low, it would have left its own line, and its own line would have been in green because it's a daily level. And so there would have been another liquidity pool beneath it there, right? And so price would have tapped into it, and then it goes again. And now that has left its own line. That's this one here. It's left its own line here. And so what happens to the next time price comes back there? You guessed it, it reverses again. Highs, lows, different time frames. That's what drives price at a high level. Can you use this and go and start trading and making money today? No. The principles we're teaching you in the Market Breakers course is how you apply this information. But we need it for those of you experienced traders, so you can see what is really driving the market, so you really have a handle on how to work with it. I'm going to sign off here now. It's almost midnight my time. Have a great week trading the markets, and I'll see you all soon. Bye-bye.